Welcome back everyone. This is the first discussion video for chapter 11. Before we get to some new material though, I did want to cover a few review type questions. First up here, suppose your firm manufactures shoes. Which variants of the ones we've discussed would obtain if the market price of canvas, leather, and other shoe materials, so our raw materials, increased unexpectedly this past period? Pause the video, look and think about those potential answers there, and then come back for the solution. So our best answer is C. Of the potential variances shown, we would likely have, or we would have, an unfavorable spending variance for these raw materials. Remember, spending variances come about because of a change in our usage of the certain input or the price. And then in chapter 10, we also broke spending variances down to a lower level into price and quantity variances. And just as point of fact, in this particular scenario, this implies that we'd have at that lower level a price variance. Looks like the price we're going to pay to suppliers has increased unexpectedly, and that's where it would come out in our variance analysis. Next up, a Ramkissoon Midwifery's cost formula for wages and salaries is $2,060 per month plus $442 per birth, so a mixed cost. For the month of July, the company planned for activity of 117 births, but the actual level of activity was 114 births. The actual wages and salaries for the month was $54,500. Wages and salaries in the planning budget were $53,774. The activity variance for wages and salaries for the month would be how much and unfavorable or favorable. Pause the video, work through that, and then again come back for the solution here. So our answer there is D, $1,326 favorable activity variance. Remember, activity variance is coming about because of a difference in our planned level of activity. In this case, the 117 births versus our actual level of activity, 114 births. Now, our actual level of activity was lower than our planned level, so we do know or can know right off the bat that any activity variance for an expense item is going to be favorable, right? Costs should be lower, assuming they move with volume or activity in some way, if our actual level of activity was lower than expected. So let's figure out what that number is here or solve for it. Again, our activity variance coming from a comparison of our flex budget to our planning budget. The flex budget would say take our cost formula and flex it for our actual level of activity. So $2,060 fixed cost per month plus $442 per birth. The 442 in this case multiplied by the 114 actual births for this particular month. So 2,060 plus 114 times the $442 gives us a flex budget amount of $52,448. We'll take the planning budget amount, $53,774, minus that flex budget amount, and there's our difference of $1,326. Again, a favorable activity variance. Moving along, which of the following could be responsible for a $2,000 unfavorable activity variance for maintenance expenses? Pause the video, look through those potential answers, give it a thought, and then come back for the solution. So our best answer there is B. Production was increased from a budgeted level of 12,000 or 10,000 units, to 12,000 units to account for increased customer demand. As we mentioned in the previous example, activity variances come about because of a difference in our planned level of activity and our actual level of activity. They do not speak in any way to our usage of inputs, the price of those inputs, or anything else, strictly because of a difference in planned activity versus actual activity. So B's our only fit there. Next, suppose your company is in the middle of its performance evaluation / variance analysis cycle and has come up with the following results. We have a revenue variance of $10,000 favorable, a materials spending variance of $2,000 unfavorable, a materials price variance of $1,000 unfavorable, and a materials activity variance of $500 favorable. What must the materials quantity variance be for the same period? Again, pause the video here, work through that, and then come back for solution. Our answer there is A, 1,000 unfavorable. So we know that our spending variance, which we covered in chapter 9, is the summation or the aggregation, if you will, of our lower level price and quantity variances from chapter 10. So in this case, we know the spending variance was 2,000 unfavorable. We know the price variance was 1,000 unfavorable. And that means the difference between the 2,000 and the 1,000 must have been our quantity variance. So that quantity variance must have also been 1,000 unfavorable. Finally, suppose after careful analysis, your company's determined that the standard labor time required for 1 unit of your most popular product, the ShamWow, is 0.5 hours. Direct labor hours are also used as the allocation base for overhead costs. In recent periods, your company has experienced significant turnover in your workforce, and new employees are still getting up to speed on some production processes. This has led to increases in rework, so that's fixing or remaking poor quality ShamWows, and average production times per unit of 0.75 hours. Which of the following variances would result from this set of circumstances? Pause the video here, look through those potential solutions, give it some thought, and then come back for some discussion. So our answer there is E. A, B, and C all could result from that set of circumstances. So let's go through the 3 potential types of variances here in A, B, and C. A was an unfavorable labor efficiency variance. Now it does tell us that average production times are 0.75 hours per unit. Our standard says it should be 0.5 hours. So yeah, we could have an unfavorable labor efficiency variance. It's taking longer than the standard says it should to make each unit. Next, we had an unfavorable materials quantity variance. This one a little trickier. It did say that the employees are still getting up to speed on some production processes. And as part of that, they're having to remake poor quality ShamWows or fix their old ones. So they may be wasting material in that process, having to throw away ones that aren't made correctly and make the new ones the right way. So we could have an unfavorable quantity variance for materials because of that. And then finally, C was an unfavorable overhead efficiency variance, and that relates directly to A. Again, labor hours was the allocation base for overhead. Right now, these things are taking a bit longer than the standard says they should to produce, so we also could have the unfavorable overhead efficiency variance there as well. Okay, let's move on to some new material. Chapter 11 was titled Responsibility Accounting Systems, and we've talked about responsibility accounting a little bit in earlier chapters. This idea that we want to try to hold managers accountable just for the things under which they have some kind of control. Now, considerations for responsibility accounting increase the more that firms are decentralized. Now, decentralization just means that we've empowered lower level managers with greater and greater responsibility or more decision rights. Right? In other words, we're not a very flat organization. We have a bunch of different levels. There are some potential benefits of decentralization. In those cases where lower level managers are more empowered to make their own decisions, they gain experience in that decision making. This down the road could potentially set us up to be better at promoting from within when it comes to finding new executive level managers. Also, we're freeing up top management more to concentrate on the bigger picture, on business strategy. They're not tied down with the day-to-day operational decisions. So again, they're more free to focus on the bigger picture items. Now, one thing we've talked about with regard to some other things during this session is that often these lower level managers have the best information from which to make decisions. So if we're decentralizing decision-making authority, we probably have this benefit of having the folks who know the most about those potential decision contexts making those decisions. Relatedly, lower level managers can respond more quickly to customers. Again, they're sort of on the front lines, right? They're dealing with the day-to-days of the operations of their team, the interfaces with customers if it's a customer-facing group. So they're going to be able to react to changing things in the environment a bit more quickly than the top-level management would in that regard. And then in the bottom here, decision-making authority tends to lead to greater job satisfaction. From accounting and organizational behavior research, decentralization would seem to boost group identification, which can also boost performance, cooperation, and commitment to group goals. So if we empower lower-level managers with making decisions that affect their part of the world, we may be increasing their motivation and their satisfaction. There are some potential disadvantages to decentralization, though. Lower level managers may be too focused in a way on their own small part of the organization, and they may make decisions without seeing the big picture. So that may be one potential thing we need to keep an eye on. And related to that is this point in the lower bottom left here. Lower level managers' objectives may not be those of the organization. In other words, we might have incentive disalignment. Lower level managers may be first and foremost concerned with just kind of operating their part of the organization, and they're worried about their own compensation and their own team member satisfaction and how those team members are working and such. So again, maybe missing sort of some of these big picture items. The other two kind of fit together as well. First, there may be a lack of coordination among autonomous managers. If everyone's kind of off doing their own separate thing, and we need some cooperation between divisions and segments and product lines and such, we may be missing out on that if we have decentralized that decision-making authority. And then relatedly, it may be difficult to spread innovative ideas in the organization. Again, if we've got everyone off kind of making their own decisions in a vacuum, right, or in isolation, we may not be sharing knowledge as best as we can. So another potential drawback for us there. Now, with this idea of responsibility accounting, we have what's called responsibility centers. And there's really three types. There's cost centers, profit centers, and investment centers. A cost center is really just any segment or part of the organization whose manager has control over cost, but not over any kind of revenue or investment funds. So in an organization, that would be things like all the support functions, information technology, legal, finance, human resources, right? Facilities, all those types of things. Again, very crucial to running the business. They don't generate any revenue though. And managers in those cases, a lot of times don't have the ability to kind of expand operations to make capital investments. So they're really just a cost line. Next would be the profit center. And that's any segment or part of the organization where the manager has control over both costs and revenues, but doesn't control investment funds. So they are customer facing in some way. They generate revenue. They also have costs associated with them, but they're not tasked with making capital investments. Some examples out there in the world would be things like individual retail stores. For some reason, I always think of like the Verizon and ACCT stores. So the managers of those are certainly tasked with controlling revenue, generating sales in the store. They're tasked with controlling costs. They have staffing costs, facility costs for the store itself, all those types of things. But they can't turn around and just open another store down the block without some other kind of decision being made from upper level management. And then finally, we have an investment center. So that's any segment whose manager has control over costs, revenues, and investments. So they're customer facing, they're generating sales or revenue of some type. They certainly have costs associated with their part of the operation, and they can make investments in capital and productive assets. So a manager of a certain product line within an organization probably fits this type of description. If you think about within, say, Coca-Cola, the individual product line managers there who oversee Coke and all the different types of products that Coke bottles and makes, they likely have control over all those things. They're tasked with generating sales at a high level. They certainly control cost in terms of production and operations, and they can likely make investments in capital and productive assets. So our first learning objective here was to compute return on investment and show how changes in sales, expenses, and assets affect ROI. Really, this section of Chapter 11 is concerned with the performance evaluation of particular responsibility centers and what may be best to evaluate them. So return on investment can be calculated as net operating income, where that is income before interest and taxes, divided by average operating assets. And typically that would include cash, accounts receivable, inventory, plant and equipment, and then any other productive assets. In other words, not assets held for sale or investment. Most companies do use the net book value of depreciable assets to calculate that average operating assets. And net book value, just as a refresher from our accounting principles, would be that historical cost less any accumulated depreciation. So this is a number that could change over time, right? As assets age and are depreciated more and more, this number actually shrinks a bit, at least in the absence of making new investments over time. Now, ROI can also be broken down into two separate measures that tell us some interesting things about operations. The first is margin, and we have had several different margin terms in this class. This is just overall profit margin, essentially. So it's the net operating income divided by sales. What portion of every sales dollar makes it all the way through to bottom line net income there? And then the second submeasure is turnover. And that's a measure of productivity. It's sales divided by those average operating assets, trying to say how often or how many times does the division or segment turn over its assets in generating sales. So ROI can also be calculated as the product of those two submeasures, margin times turnover. So let's look at an example and look at how ROI can change over time with changes in some of these pieces. So let's say Regal Company reports the following: net income of $30,000, average operating assets of $200,000, sales of $500,000, and operating expenses of $470,000. Let's find their ROI under that scenario, and then think about what might happen to it with some changes in some of those pieces. So let's do the margin times turnover version, if you will, rather than just calculating it as net income divided by assets. So that margin would be their $30,000 net income divided by sales of $500,000, and that's 6%, times the turnover, which is their sales of $500,000, divided by the average operating assets of $200,000, or 2.5. So ROI then is 6% times 2.5, or 15%. We're saying this division returns 15% on its investment of those average operating assets of $200,000. Again, we can find that directly if we wish, so to speak, by taking the net income of $30,000 divided by the average operating assets of $200,000. Works just the same. Now let's assume that Regal's manager invests in a $30,000 piece of equipment that increases productivity in some way, makes a product better, whatever. And so as a result, that increases sales by $35,000 while increasing operating expenses by $15,000. It's not free to run, in other words. So now they report the following. Net income has changed to $50,000. Average operating assets has increased to $230,000. Sales has increased to $535,000. And operating expenses has increased to $485,000. Let's look at what that does to ROI. So now our new margin is a net income of $50,000 divided by sales of $535,000. So it's all the way up to 9.35% from its old mark of 6%. Turnover, though, has gone a tiny bit in the other direction. Sales has increased to $535,000. But the average operating assets have also increased to $230,000, so the new turnover is 2.33. That new ROI, though, we've seen a bump there. 9.35% margin times turnover of 2.33 leaves us with an ROI just shy of 22%. So it's increased in this case with that investment from 15% to almost 22%. Now, ROI is extremely popular in practice. You'll see it pretty much everywhere. And some of you may have seen it in a finance class, a corporate finance class. It's not perfect, though. In the absence of a balanced scorecard that addresses a lot of different performance measures and dimensions, management may not have a great sense of how to increase ROI. Managers often might also inherit a whole bunch of committed costs, and we talked about those earlier this semester, over which they have no control. So costs that were associated with plant and equipment that were around long before they ever showed up. They may not feel that that's right or that's fair. And managers evaluated on ROI may also reject profitable investment opportunities from the company's standpoint. It's referred to as the classic underinvestment problem. In other words, if a manager is evaluated based on ROI, they're going to want to pursue investments that can increase their overall ROI. In some cases, we may have investment opportunities that don't increase a manager's individual ROI, but are greater than some required return that the company has in mind, and managers might be rejecting those. So again, referred to as the classic underinvestment problem. So let's take a quick sidebar and think about this. A potential advantage of using ROI then to evaluate performance is that it encourages the manager to reduce the investment in operating assets as well as increase net operating income. Is that true or false? Give that a quick thought here, pause if you'd like, and then come back for the solution. So that is true. Since those average operating assets are part of the determination of ROI, it does encourage managers to at least think about the effect that increasing or decreasing those has on their potential performance measure. It doesn't mean they're walking around trying to sell off all the plant and equipment that they have, but just to kind of makes them a little more aware of these things. Next up, all other things the same, an increase in unit sales will normally result in an increase in the return on investment. Is that true or false? Come back for the solution in just a second here. That is true, right? If we're increasing sales and everything else is staying the same, then we should be seeing an increase in income and no change in average operating assets, so our return on investment should be increasing as well. Let's try another one with some numbers here. So let's say Tenalink has a $1,400,000 investment opportunity with the following characteristics. It would generate sales of $4,480,000. The contribution margin ratio for that would be 40%, and fixed expenses would be $1,657,600. The ROI for this investment opportunity would be what? So pause this, work through that scenario, and then come back for the solution. The ROI here would be D, 9.6%. So we'll go ahead and find our net income first. Take our sales of $4,480,000 times our contribution margin ratio of 40%. That would give us our total CM. Minus our fixed expenses of $1,657,600 would give us net income of $134,400. Divide that net income by that investment amount of $1,400,000, and we get a return on that investment of 9.6%. Okay, one more here. Redmond Awnings, a division of Wrap-Up Corp., has a net operating income of $60,000 and average operating assets of $300,000. If the manager of the division is evaluated based on ROI, will she want to make an investment of $100,000 that would generate additional net income of $18,000 per year? So pause this, work through that scenario, and then come back to check your answer. So the answer there is no. The current ROI would be the net income of $60,000 divided by the average operating assets of $300,000, or 20%. The new ROI, if they make that investment, would be new net income of $78,000 divided by new average operating assets of $400,000, or 19.5%. So this new investment would actually lower the division's overall ROI from 20% to 19.5%. And this is what we were referring to earlier with this underinvestment problem. This is potentially a very profitable project for the company as a whole, but the manager probably doesn't want to take it on because it's going to decrease their ROI. They want to be accepting things, in other words, that are at least keeping their ROI the same, if not increasing it to any extent possible. And that brings us to learning objective 2, which was to compute residual income, another performance measure, and understand its strengths and weaknesses. So residual income is defined as net operating income above some minimum required return on operating assets. So it can be calculated as a division or segment's net operating income minus their average operating assets times some minimum required rate of return. So this would be set probably at the corporate level, or at least at that division level. It's what the firm decides is their cost of capital or some blended rate against some target required rate of return. So just real quick, note the difference from return on investment. Return on investment measures net income earned relative to an investment in average operating assets, while residual income measures net income above and beyond some required return on investment. So let's look at an example here. Let's say the retail division of Zephyr has average operating assets of $100,000 and is required to earn a return of 20% on those assets. In the current period, the division earns $30,000. Their residual income in this case is their actual income of $30,000 minus their minimum required return on their assets. And that's calculated here. Assets of 100,000 times required return of 20% is a capital charge of 20,000. So their net income 30,000 minus the capital charge of 20,000 means they have residual income of $10,000. Now in terms of acceptability or profitability or desirability, we'd say that all else equal, anything with residual income at 0 or greater would be considered, pretty good or acceptable or fine because it accounts for some minimum required rate of return. In other words, if the company says that the required rate of return should be 20% and a division is returning exactly 20%, their residual income is going to be exactly 0. So that doesn't mean it's bad, right? They are returning, in fact, 20%, which is what the requirement was. So for our purposes, again, any residual income 0 or higher, we're going to say that's, a pretty good thing. Now, relative to ROI, residual income encourages managers to make profitable investments that would otherwise be rejected if those managers were being evaluated using ROI. And this isn't, a magic process or anything like that. It's just about how we've incorporated this minimum required rate of return. So let's extend our earlier example with the manager who is going to turn down an investment opportunity to illustrate that. So let's say in that same scenario from a couple minutes ago, the company's required rate of return was 15%. They're saying any project that managers are taking on should return at least 15%. Would the company want the manager of the Redmond Awnings division to make this investment of $100,000 that would generate additional net income of $18,000 per year, keeping in mind that they rejected it or would want to reject it under ROI? So pause this, think about that for a second, and then come back here. And the answer is yes, right? The return on that investment is 18%. That's going to generate some positive residual income. Right? Residual income in this case is the $18,000 income that would be generated minus the capital charge, which would be 15% of the $100,000 investment, or $15,000. So residual income becomes $18,000 minus $15,000, and that's $3,000. Okay, any manager in this case evaluated with ROI would want to accept that project. They're going to accept anything that has residual income of at least 0. So there's a potential difference for us with regard to residual income and ROI, something to be aware of. Let's try another question here. Mike Corp uses residual income to evaluate the performance of its divisions. In January, the commercial products division had average operating assets of $970,000 and net income of $143,700. Residual income for the same period was $7,900. What must Mike's required rate of return be? Pause this, work through that, and then come back for the solution here. So we know that residual income is the net income earned minus that capital charge. So the average operating assets times the required rate of return. In this case, we know residual income is positive $7,900. So that would be equal to the net income of $143,700 minus whatever that required rate of return is on the assets of $970,000. So simplifying a little, that gives us $135,800 on this side is equal to $970,000 times that required rate of return. Divide both sides by the $970,000 and we get a required rate of return of 14%. Also worth noting here that if someone came along and asked you, well, what was their actual rate of return? Was it less than, equal to, or greater than 14%? We'd know that it's somewhere greater than 14% because residual income was positive. Right? If it had returned exactly 14%, residual income would be exactly 0. If it had returned something less than 14%, residual income would be less than 0 or negative. So one thing for us to be aware of with residual income, since it seems like in some cases it could be preferred above return on investment, is that there is a disadvantage with regard to comparability. It really can't be used to compare the performance of divisions or segments or firms even of different sizes. So let's illustrate that here. We had the retail division of Zephyr a minute ago. We said they had operating assets of $100,000, required rate of return of 20%. They had actual income of $30,000, so they were generating residual income of $10,000. Now let's assume that Zephyr also has a wholesale division. And let's say that division has operating assets of $1 million, so 10 times as much as the retail division. Same required rate of return, 20%. So their minimum required return is $200,000. Now let's say their actual income for the period was $220,000. That would give them residual income of $220,000 minus the capital charge of $200,000 or $20,000. Now at the surface, we'd kind of look at that side by side and say, well, the wholesale division's doing better though. They're generating $20,000 in residual income, which is twice as much as the retail division. Let's make sure we pat that manager on the back and let's make sure we talk to the manager of the retail division, see what's going on. But it's a little more complex than that. The retail division is a whole lot smaller. They have less assets by which to generate that income. So just mechanically speaking, they're going to generate less residual income with greater rates of return. So we really want to think about the rate of return for each of these two divisions. The wholesale division generated return on investment of $220,000 divided by $1 million in assets, or 22%. The retail division generated income of $30,000 on assets of $100,000, which is an ROI of 30%. So the retail division is getting sort of more bang for the buck, we might say. And again, they're just hampered, if you will, at least relative to the wholesale division, by the size of the division, the amount of productive assets they have. So we have to be careful there. Residual income really does not lend itself to comparability when there's a difference in size between the divisions or segments. And that wraps up the first discussion here for Chapter 11. Feel free to back up to any portion you need to. And as always, let me know if you have questions.